In this video, what I want to do is go over chapter 3's problem number 7. Most people got this wrong. One of the things that most people tried to do was take the max amount of the taxable tax rate and multiply that by the taxable income. What you're missing is that whole idea of the progressive tax system that we have here in the United States. See, what happens is, if you look at the table that was in the text, the first $9,300 is taxed at 10%. Above that $9,300, now this is for single taxpayers, above the $9,300 up to the $37,950, that amount there is taxed at 15%. Then the next level up, okay, in other words, from the bottom of this bracket to the top of this bracket is taxed at 25%. So you can see that it's a mistake to try to say, okay, they're in that 55% bracket, we're going to tax them at 25%. No, the first part is taxed only at 10%, the next part at 15%, the next part at 25%. So if you do the calculations, the first $1,350 for the head of household, you'll see this is head of household taxable income. Now this is taxable income after deductions and adjustments and things like that. The taxable income is $55,000. So the first $1,350 is taxed at 10%. So 10% times the $1,350 gives you the $1,335. The next level up between $50,800 and $13,351 is taxed at 15%. So if we subtract the $50,800 minus the $13,351 times the 15%, we get $5,600. Now the max is $55,000 that they made. So they're in that next tax bracket. So the $55,000 minus the bottom of that bracket, $55,000 minus the $50,801 is taxed at 25%, gives you this amount. So the tax amount that they will make or have to pay is $8,002. For a single person, income of $35,000, a taxable income of $35,000. Looking at this portion of the table here, the first $9,300 is taxed at 10%. Between the $9,300 and the $37,950, it's taxed at 15%. So we have 10% times the $9,325 gives us $932. They made $35,000. They're in that next bracket, see? Between $35,000 and $93.26, it's taxed at 15%, which gives you this $3,800. Total tax bill, $4,783. For married, filing jointly with a taxable income of $72,000. Married filing jointly. Okay, so in other words, after all the deductions and adjustments, the first $18,650 is taxed at 10%. The next level up is taxed at 15. The next level up, taxed at 25. So here you have the first $18,650, it's taxed at 10%, so you have your $18,665. Now they don't go beyond the max in that level, in that bracket. So the $72,000 minus the bottom of that bracket at 15% gives you $8,000. So their total tax bill is $9,867. So the thing you have to remember is it's a progressive tax system that we have in the United States. As you make more money, you pay a higher tax. Now, this is actually based on the old taxes. Based on the Tax Act of 2018, there is a new set of rates and some new rules. You can see the rates are different. They've actually been lowered, particularly for these lower levels. Okay? And you can see that the brackets have been expanded. If you look at the differences between the brackets, you can see that there's an expansion in the brackets. So, keeping everything the same, if for 2020, what is it that they're going to be paying? Head of household, $55,000. So you're going to use this portion of the table here. you can see the first $14,000 is taxed at 10%. So you have your 10% times 14,000 gives you $1,400. Between 5,300 and 14,000, it's taxed at 12%. So you take your 53,700, top of the bracket, minus the 14,101, the bottom of that bracket, which is taxed at 12%, gives you $4,700. They made 55,000. They're in this next bracket. They haven't gone over that bracket. So the 55,000 minus the 53,700, all right, the bottom of that bracket, which is taxed at 22%. 55 minus the 53,700 at 22% gives you $285. They're paying $64.47. You can see that there's a difference between 2020 as far as the taxes they're paying and 2017. $1,600 as far as less tax that somebody who is head of household with taxable income is paying, over $100 a month as far as federal income tax. Single person with $35,000 taxable income after deductions and things like this. Here's your single level. The first $9,800 is taxed at 10%. So 10 times 9,875 gives you this. Next level up, they don't go beyond this level of that bracket. So 35,000 minus the bottom of that bracket, which is taxed at 12%, gives you this much. They're paying $4,002. You can see that's less than the $4,700 that they would have paid in 2017. $780 less that they're paying in taxes. Married filing jointly, taxable income. Taxable income is $72,000 using this portion of the table. The first $19,750 is taxed at 10%. You can see that here, $19,750 times 10 gives you the $19,775. They don't go beyond the upper limit of the next bracket. So the $72,000 minus the $19,511, the bottom of that bracket, is taxed at 12%. So your $72,000 minus the $19,750 times the 12% gives you $6,200. Their total tax bill, $8,244. You can see that's less than the $9,800 that they would have paid in 2017. $1,600 difference. Now, you can see from the brackets, we're paying less taxes. Another key difference are the standard deductions. The standard deductions have been doubled, over doubled in some cases. So you can see the standard deductions in 2017 for a single person, $6,350. For a single person in 2020, $12,400. Married filing jointly, $12,700 to $24,800. And for head of household, $9,350 to $18,600. So you can see that there's a bigger standard deduction. Another key difference is what's called SALT taxes, state and local taxes. It used to be that in doing your deductions, you could gather up all of the state and local taxes that you paid, and you could reduce your tax bill by that amount. And there was no limit on that. What they did in this tax act was they limited the SALT taxes to $10,000. You can only deduct from your taxes a maximum of $10,000. Now, you have somebody who might be having $1 million in taxable income, all right? And maybe they had $100,000 in SALT taxes. Married filing jointly, this sort of thing. Went through, calculated it. Because they used to be able to deduct $100,000 from their taxes, they would actually be paying less federal taxes than they are now because they can't deduct as much. So the SALT taxes has helped to increase the amount of taxes that the quote-unquote rich pay. So you can see that in 2017, they would have paid $301,000 based on the tax tables. And in 2020, because they could not deduct everything as far as their sales, state and local taxes, they're paying more in taxes. Now, let me show you what actually happens also. This is not taking into account the increase in the standard deduction. Let's adjust this some. Let's say that you're looking at these same things, but instead of taxable income, it's gross income. So in other words, this is what it is that the company has paid you. Now, we're not taking into account anything like 401k contributions or anything like that. We're looking at, okay, here is the total amount before taxes and everything that the company paid. And this is what you had. So let's say that you have head of household at $55,000. And everybody's taking the standard deduction, let's say. So you have your $55,000 minus your standard deduction. So your standard deduction in 2017 was $9,350 for the head of household, which means their taxable income would have been $45,000. You go through the tax tables, you come up with they're going to pay taxes of $6,000. Let's say that you have a single person with a gross income of $35,000. In other words, pre-tax. Single person has a $6,300 deduction. So they're going to have taxable income of $28,650. Walk through the tables, they're going to pay taxes of $3,800. Married filing jointly with gross income, in other words, no other deductions or anything like that, of $72,000. Married filing jointly had a standard deduction of $12,700. So they would have taxable income of $59,000. Walk through the tax tables, they're going to pay $7,900 in taxes. With the change in the Tax Act, they basically doubled the standard deductions. You can see the standard deductions for head of household, married, and single. So we take the same thing. You have head of household with a gross income of $55,000. They have a standard deduction of $18,000 now. So you take that $55,000 gross, subtract out the $18,000, you get $36,000 that they're going to pay taxes on. The total tax bill, after you walk through the table, $4,079. You can see that's quite a bit less than the $6,000 that they would have paid in 2017, based on the tax tables, based on the deductions. There's over $2,000 difference there that they are not paying in taxes. Their taxes were reduced $2,000 a year. Single person with $35,000. They have a standard deduction of $12,400. So you take that $12,400 away from the $35,000, they have taxable income of $22,600. Walk through the tables, they're going to pay total taxes of $2,514, much less than the $3,800 that they would have paid in 2017, $1,300. You have your married filing jointly, $72,000, married filing jointly, $24,800 as far as the standard deduction. Take that out, they have taxable income of $47,000. Walk through the tax tables, they're going to pay taxes of $5,268, much less than the $7,900 that they would have paid in 2017. You're looking at $2,700 difference. So don't let anybody tell you that the Tax Act, where we reduced the taxes, where we reduced the rates, we increased the standard deduction, only helped the rich. It did not. It helped all of us as far as reducing the taxes that we're paying in federal income tax. So these are some of the key points. If you have questions, give me a call.